Okay, FOMC. 15, 20 minutes. Okay, I just want your attention for 15, 20. I'm going to go through a plan. Make sure you have all of this written down. Okay, step one. The most important thing to understand is Yellen and the Fed. Okay, and we talk about this the whole time. Understanding the Fed. Where are they at the moment? What are they currently thinking at the moment? Let's have a few ideas. Go for it. Go. Come, let's talk. What's the current Fed stance?
I've got loads of stuff.
Okay,
Do
go.
you want to go to these guys first?
Go. Well, come guys. Let's Mark.
It's like they
Come
all
on, Darren.
disagree, huh?
Okay.
No one agrees.
Good. So we got a variance. Okay, we got a wide. How do we know we got a wide variance? Where do we see that?
We got comments last week on Bullard. He said he wanted
Okay.
another QE.
Good.
Another guy from San Francisco said the same. Another dovish comment.
Good.
And some other hawkish guy in the Fed said they want to
Okay.
follow the
Good. Good. Where else do we see this variance?
the dots.
As simple as that, guys. Just look at the dots. Okay, you can see the dots where some people are calling for no hike until late 2015, 2016, and some people are calling for 3-4% by the end of 2016. Okay, we've got a very wide variance between what the members are thinking. Okay, that's never a good thing. Okay, remember the FOMC effectively will need some sort of a majority rule. They'll need everyone to come together, but more importantly, who has the underlying decision at the end of the day? Who makes the choice of whether hikes go up or whether they're bullish or
Yellen,
hawkish?
Dudley and Fisher.
Good. So effectively,
Yes.
Yellen is the most important one to understand. Okay, where's her stance?
And we know she's in the bottom of the
Okay, good. So we know Yellen is somewhere toward the bottom. Okay, you all understand that. Very important. Yellen is not the most dovish, okay, but she is very much a dove. Okay, she's very much about slack in the economy. She's very much about the labour side of the economy, yes.
I'm chatting with a couple of friends at
Yep.
banks, and the consensus seems to be she's in the bottom quartile.
Okay, good. Okay, so we know she's at the bottom. What else about the FOMC? What's this current stance of the FOMC?
Well, it's quite dovish in terms of its statement,
Okay, good.
but tapering's meant to end tomorrow.
Okay, good.
That's the sort of the big headline thing.
Okay.
What they haven't really started to reveal their stance on yet is their exit strategy,
Okay, good.
and so that's the big question
Okay.
mark that we don't know. They've
Good.
talked about rate hikes.
Good,
We
good,
know
good.
they disagree on that.
Okay.
We know they agree on ending tapering.
Yep.
Where do they stand on their
Okay.
exit strategy?
Good. Right now, guys, I agree with you. We'll get to that part of the plan. The first thing is, what is the FOMC stance? Okay, what's moving the markets right now? What's the headline that Yellen has said to us every single conference?
Considerable time.
Okay, so considerable time remains. What else? We'll get to considerable time in language.
They were worried about the dollar last time.
Okay, good. So dollar.
Global growth.
Okay, so the dollar and global growth were important to the Fed. But more importantly, one step back. What has Yellen mentioned for the last 3-4 FOMCs?
Data dependent.
Good. The Fed are effectively data dependent. Okay, that's so important, guys. You have to understand that. They're data dependent. And what else has she said with regards to data dependent? Come on, finish it off.
Well,
Why has she
On
said
a
they're data
preset
dependent? Put it that
course.
way.
because that way it leaves more of a fairer, no, a more, what's the word, sustainable recovery.
Okay, good. You hit the nail on the head.
Preset course.
Okay. She doesn't want to put the Fed on a preset course. She said what? She said interest rates can go up sooner than expected. Interest rates can stay lower for longer than expected. Okay, so she's left an open-ended. She said to the market, I don't know where interest rates are going. They will go up. They will normalize, but I don't know when. So rather what I'm going to do is I'm going to tell you they're data dependent. Simple as that. Okay, that is her language to the market right now, data dependent. So long as she remains data dependent, the market won't be able to pick up on, they won't be able to be guided on interest rates. Okay, it's so important to understand that, guys, because by understanding that, when the statement comes out tomorrow, you'll get a better idea of how the Fed can actually go forward, or how they can change the language. Okay, so that's step one, understanding your central bank. Okay, so make sure, guys, write it out. Write down whatever you understand about the Fed and Yellen and its members. Okay, then step two, we move on. Step two is now the
markets.
language. Okay, we'll go to the markets later on. Language is first. Okay, someone said the famous, infamous, considerable time. Okay. So the Fed Well, rates will remain low for considerable time after bond purchases end. Okay, don't forget, guys, please, if you don't know, for the newer guys, just because tapering is ending doesn't mean they're not still reinvesting. Okay, all it means is they're not putting fresh money into the bonds every month. Okay, so every month the bonds mature and you get coupons. Okay, you receive money for buying those bonds. They go and reinvest those into treasury. So they are still buying bonds. Okay, they're not just putting in 15 billion fresh every month. That is effectively what the tapering is doing. Okay, so considerable time. Let's talk about this. What has Yellen told us about considerable time? Yes.
Considerable time was always referred to the tapering, the end of QE.
Yes.
Now that QE is ended,
Yes.
what is the reference, the next reference?
Okay. What is the rate? Well, let's first understand
Well,
what considerable time means.
Currently, it says rates will remain at present levels for a considerable time after the end of the taper.
Exactly.
Yeah.
So that considerable time can still be from the end of the taper because they've never put or they claim to have never put a figure on it. Now at Yellen's first meeting, she got all hot and bothered and
Yeah.
put 6 months on it, and
Okay.
then spent 6 months backtracking from that.
Okay.
Also, something which I just want to flag up,
Yep.
which got, I think, completely missed,
Yep.
including by me at the time. But on the 9th, so just a few days ago, 2 people came out and did put a number on that. So Fisher with an S, who's the deputy governor,
Mhm.
and Lacker, who's one of the big hawks, came out and said 2 to 12 months,
Okay.
which basically means they have no clue.
Okay.
It is
Again.
the broadest possible range, they
Okay.
have no idea.
Good.
It's like everything, they have no clue for
Okay.
anything. You can look at the dots or
Okay, of course. Okay, so the important thing is, guys, is to understand considerable time means how long?
An
Now, 1
indeterminate
year.
amount of
Okay,
time.
it means no one knows. Okay, Yellen has explicitly stated that considerable time does not mean 6 months. Okay, she said it a number of times. So don't be surprised if potentially that gets dropped. Okay, that'll be part of your plan. We're going to go through that, and that's why we're going through language. But how are you going to react if she drops the considerable time? Okay, and the only way you'll know how to react is by knowing what considerable time actually means. Okay, what are the language?
Looking at the jobless rate.
Good. Okay, so let's go to employment, the employment situation.
Yeah.
Okay, so what has she said about employment, labour market? She said, I've got it in front of me if you want me to read it. Okay, so effectively she said labour market indicators suggest significant underutilization of labour resources. Okay, so again, that's going to be one of the key phrases. Is there still significant underutilization of labour resources? Okay, in the next stage we're going to go through obviously the data over the month. Okay, but effectively we went from 6.1% to 5.9% at the non-farms. Okay, we also had the, I think it was 240k growth in jobs, and then wages. What did wage earnings growth do? Okay, it went down from 0.2 to 0. Okay, so that's what Yellen keeps banging on about. She keeps saying, well, we've got unemployment dropping, we're creating jobs, but what's happening to wages? Okay, so how much slack is there in this economy? Okay, you all know basic economics. If there's a strong demand for jobs, what should wages do? Should they go up or down?
Up.
Okay, wages should rise. Okay, if there's less jobs to employ people with, or less people to employ for the jobs, wages should go up, but they're actually going down, and that's the slack Yellen keeps talking about. Okay, underutilization of labour resources.
And the speakers have been out in the last week saying they still think there's
Good.
significant slack.
Good, good, good. Okay.
So what we do if she pull this?
Okay, well, we're going to go through that now in a minute. Next, let's just go through the language, that's important. Okay, the third piece of language is about inflation. What is the Fed talking about inflation? Okay, it's running below objective, but it's stable. Okay, so it's below the objective of 2%, but it's stable. Okay, so how do they, if they want to become more dovish or hawkish, how can they change that? Okay, good. And then the last bit of language, which again might be added, okay, is obviously the current weakness in the global economy. Okay, and obviously the dollar strength that one of you mentioned. Okay, so those effectively, if you go through the statements for the last however many past this year, those are the 4 key real parts of language that can be altered and adjusted to be hawkish, dovish, or neutral. Okay, you all got step 2, language. Okay, step 3 is the outcomes. Okay, and this is the fun part. Okay, so now we write outcomes, and we first write in our outcome section is what is the market expecting? Just in terms of outcomes, what does the market expect tomorrow?
The end of the.
Okay,
QE.
good. So taper 15.
So now it's 0, correct?
Okay, hey.
So now, yeah, it's gonna be 0.
Okay, good. So we'll go to 0. So no more bond purchases. What else are we expecting?
They're expecting something dovish.
Okay, good. So they're expecting almost Yellen to just confirm this global slowdown. Almost just tell the markets, yes, we acknowledge the rest of the world is slowing. Yes, we acknowledge the stronger dollar. Yes, everything is as expected and everything's going to be fine going forward. Okay, there's a bit of an expectation for Yellen just to confirm the current concern in the market. Okay, yep.
Well, I was going to say, I don't know that Imran's going to discuss it with
Yep.
these guys, but as I did it, I
Yep.
know we'll show it. The chart
Yep.
that obviously we were
Yep.
doing earlier of where the market is currently pricing
Yep.
the rates to
Yep.
be. So after the last meeting, they were more dovish than the Fed.
Yep.
Now they're even more dovish than they were there. So I don't know whether you guys can see that chart there, but the blue dots are the Fed,
Yeah,
the yellow dots are the last meeting, and then the red dots are now.
Okay,
So
I'll draw it for you.
yeah, if Brandon
Okay, so
wants to draw
effectively,
it.
that's where the market was before the last meeting. Okay, and that was the Fed funds dots. Okay, so the Fed officials were effectively more hawkish than the market. Okay, and since the previous meeting, we've done something along those lines. Okay, so the dots remain where they are, but the market has effectively become even more dovish.
the dots are even higher now.
No, not since the last meeting. Okay, the dots have remained the same since the last meeting. Okay, that's the Fed officials' expectations. Okay, we're going to go through it in terms of pricing, but yes, very good point. Okay, so the market is expecting something dovish, something on the dovish side. Okay, it's so important to understand that because when you go and look at what comes out, you need to understand firstly, well, what is the market expecting? What does the market want? Okay, then what you do is you go and you write yourself a little bit of a neutral, hawkish, dovish. Okay, and this is the fun part, guys. This is where you go and scenario bash. Okay, this is where you go say to yourself, well, in which situation, based on the language and based on the expectations, will I be hawkish? Okay, so let's go through those 3 pieces of language. First one was highly considerable or highly accommodative for considerable time. Bang, Yellen drops the considerable time. Who's hawkish? Okay, anyone dovish? If she drops considerable time, anyone neutral? Okay, guys, you have to have an opinion, by the way. You can't be nothing. Okay, you're either neutral, you're hawkish, or you're dovish. So she drops accommodative policy. So the Fed will remain at lower rates for some time. Bang. Who's hawkish? Hands up.
Yes.
Okay, hands up high, guys. Be proud if you're a hawk. Okay, there we go. Cool. We've got some hawks. Who's dovish? Okay, who's neutral? Okay, good. I'll go neutral. Okay, brilliant. Have an opinion. There's no right or wrong. Okay, the market will react. Of course, you're going to get fast money going, it's hawkish, you drop considerable time, and the market will move in a hawkish way. But then smart money will say, well, considerable time doesn't mean any kind time frame. Okay, it's about interpretation. It's about how you as traders interpret it. Okay, bang. Second one. Inflation is now running. Okay, so inflation running below objective, but it's stable. So let's say Yellen comes out, she says inflation is running below the objective and no longer stable. Who's hawkish? Who's dovish? Who's neutral? Okay, so Yellen has come out and said to us that inflation is no longer stable. Okay, how do you interpret that? Again, guys, there's no right, there's no wrong. But the important thing is you have to go and write in which scenario am I going to be hawkish, which scenario am I going to be dovish. Okay, so that when the statement comes out and reads, you go, oh, bang, she left inflation, bang, she left considerable, oh, she changed her stance on the unemployment, bang, I'm in, I'm involved, I know, I understand what she's trying to tell me. Okay, but unless you do the situation analysis, you're going to have no clue. You're going to look at the ladders and go, and you're going to just do your ass. You're not going to make any money. Okay, good. So the third one was, labour market indicators suggest significant underutilization of resources. Okay, so if she says that, you know what, the labour market indicators suggest a much more better utilization of labour resources, how are you going to respond? Hawkish, dovish, neutral. Okay, guys, can you understand why it's so important just to do these scenario analysis? Okay, what other little situations or outcomes could we have that could be hawkish, neutral, or dovish? Okay, no taper tomorrow. What would that be? Who's hawkish if no taper? Who's neutral? Who's dovish? Okay, you're all dovish. Good. Okay, why? Darren, why are we dovish if suddenly no taper? Okay, come on, Yellen says no taper. Why are we dovish?
It's the prep for QE4.
Eh?
No, but
It's the
it
prep
means
for
the market
QE4.
still need some sort of help.
Okay,
So
good.
it's not like
Good.
it's not still recovered.
Good. I'm glad to see you guys are awake. Okay, so make sure, guys, when you do your preparation tonight, do your scenario analysis in your neutral, in your hawkish, in your dovish. No ifs and buts, guys. This is the biggest danger about going to your mate and saying, "Listen, Jet, what are you gonna do if she tapers 15 but changes labour?" And you're gonna go and say, "Well, yeah, I think it's a bit dovish." But actually, I was hawkish. I was hawkish on that when you were dovish. Now I'm like, well, he's quite a smart guy, actually. I remember him doing that trade yesterday where he made 10 ticks and I lost money. But shoot, am I dovish or hawkish now? Okay, guys, make sure, before you even discuss your plan with anyone, make sure in your head you understand your own plan. Okay? A good trader is someone who lives and dies by his opinion. You will never see me back down from my opinion, ever. Whether I'm right or whether I'm wrong, I'm never going to back down from my opinion, because as a trader, I'm putting money behind my opinion, my beliefs, not any one of your beliefs. Okay, do you all understand that, guys? The ultra a good trader, a George Soros, any of these guys, are the ones that say, you know what, bugger that, Bank of England, you're wrong, I'm taking you on. You are wrong, the rest of the market's wrong, I will take you on. And that's why he's a billionaire today, and the rest of us are sitting here trying to figure this out.
If the market is wrong tomorrow, I prefer to be wrong.
Okay. Sorry?
I'm not George Soros.
Okay.
I put my 3 lots on.
Okay.
I
Okay.
prefer to be wrong.
Good. Okay, you all happy with this? Good? Yes, Darren, you happy? Cool. Let's move on. Okay, so we've got our outcomes. Next. Okay, and this will probably come slightly before the outcomes. This should probably come a little bit earlier on, okay? But what has the data done over the previous month? Okay, why is it so important to have a look at the data? Okay,
To make comparison.
okay, make comparisons.
I mean, the Fed is the independent, so.
Okay, guys, nail on the head. The Fed has told us they're data dependent. They're all going to be sitting there, and Bullard's going to go, well, Yellen, this did this, and Koch-Lakota's going to go, no, but that did that. Okay, that's how they fight their case, data dependent. Okay, so let's go over the data. What's the most important data to the Fed?
The inflation,
Okay, so pretty much inflation and number 2.
jobs.
Okay, why? Please explain that to us. Why are those the 2 most important pieces of data?
Well, the employment, just explained the underutilization. And
Come on,
the-
simple answer. Why are those the 2 most important pieces
It's
of
just
data?
their targets to.
Okay, it's the mandate. It's the Fed's mandate to maintain price stability and employment. Okay, that is their mandate, so that's what they look for. Okay, so let's go through it. Number 1.
They don't have growth in their target, in their mandate.
Okay, well, they.
They don't have growth in their mandate.
What do you mean?
GDP.
Growth is not necessarily. Growth will effectively form part of inflation. They'll go hand in hand. But effectively, that is their mandate. Okay. So first things first. What did employment do? What did NFP do? Okay. We said we went from 6.1 to 5.9. So unemployment ticked down. Okay. We said that jobs was 248. Okay, versus 216. So a good beat. Okay. We also got a revision to the previous month. So good jobs data. Okay. But earnings was down to 0% from 0.2%. Okay, so overall, well, the employment situation is relatively good, but the earnings is a continued worry. Okay, it's the one thing that Yellen has singled out, is that wage growth is not there. Okay, so then we go to inflation. What did the inflation do last week?
1.7.
Okay, so effectively year on year, yes, the month on month, the headline went up by 0.1 on their expectation, but the core dropped by 0.1. Okay, which one's more important and why? Why?
Because the month is more volatile.
Okay, good. The core strips out volatile pieces of data. Okay, so yes, the core inflation, the hardcore stuff, the people buying stuff, spending money, okay, that ticked down. So again, mixed bag for inflation, but effectively a little bit of a downtick. Okay, core PCE. Okay, why do we look at core PCE? Okay, and again, this is going to answer your question. Why do we look at number 3, core PCE? What is PCE?
It's the expenditure,
Okay, of who?
consumer.
Okay, why is consumer expenditure so important in the US?
Because it's a consumer economy.
Okay, so effectively y equals c plus I plus g plus x minus z. You all remember that formula they taught you in university and said you have to memorize it off by heart, and you went, it's just stupid because it means nothing. Okay, it does mean something. GDP effectively equals consumption, and consumption in the US is 60 to 70%. Okay, so PCE is a piece of data the Fed looks at. They've categorically stated they look at the core PCE. Okay, effectively core PCE stayed flat, 0.1 versus 0.1 in October. Okay, what else? What else is linked to inflation or consumer? Is retail sales. Okay, we had retail sales last week. What did retail sales do?
It was bad.
Okay, it was minus 0.3 against minus 0.1 expectation. So yes, a bad print for retail sales. Okay, PMI manufacturing. Okay, what did the PMI manufacturing do at the beginning of the month? Okay, again, I don't expect you to know, but effectively, manufacturing ticked down slightly, whilst the services ticked up slightly, but more or less a flat number for manufacturing. You all happy with that? Can all of you get an idea now? If I painted you a picture and I said that is the US economy over the month of October, all of you in your head can go and say, well, employment was okay, wages are concerned, inflation, again, not great, okay, retail sales and core PC, in other words, the retailer, the consumer, seems to be struggling in all that data. Okay, yes, manufacturing was in line, yes, employment, we're creating jobs, but overall, consumers aren't spending more because they're not getting more. That's what you take from the data, and that's what the Fed will take from that data. Okay, the last one, and probably one of the most important ones, okay, I could get it up on a chart for you, or I could show it to you. We keep talking about the tips. Remember that wonderful little website I showed you, the 5-year US tips?
It's like 1.46.
Okay, good. Brilliant, you're looking at it. Effectively, you want to look, where was the market's expectations for inflation last month? Okay, and last month they were around 1.58% at the time of the FOMC meeting. Okay, and you just said as of going into tomorrow we're at 1.46%. So in other words, the Fed looks at what the market expects inflation to be. Okay, more importantly, why would the Fed want to know what the market's expectation is? I'll give you a clue. Sam Hardy showed us something. Okay, whose line is that effectively? Who does that line belong to?
Us.
The market. That's how the market perceives interest rates in the US. Whose dots are those? Okay. That's why the Fed will look, what is it that's creating this divergence between where we expect rates to be and where the market expects rates to be? Okay? And that's why they're going to look and say, okay, well, it makes sense. The market doesn't believe there's inflation. Okay? Do you all get that? Do you all understand that? Good. Okay. Now you've got a better idea of the understanding of the economy. We move on to what Max wants us to do, which is what, Max?
Market.
Okay, now we look at the markets. Okay, we're going to have a look at the markets simply because we need to first determine what is the market pricing. How's the market been pricing since the last FOMC? Okay, and then more importantly, we go and look what is going to be the easiest market to trade. Okay, so very briefly, we'll start off. Number one, Max, pick a market.
Bund.
Okay, let's go bonds, not bund, bonds. Okay, so let's start with the stirs. Okay, why do we look at the stirs? Why are the stirs important for us? Okay.
Interest rates.
Okay, it is the front end of the curve, okay? It's the raw, where are interest rates going to be 12 months, 24 months, 36 months from now, okay? And what have they done, okay? Sam Hardy drew it for us very nicely, okay? He said effectively, what we've done is we've flattened, the curve is flattened. Now the market is saying interest rates are not going to rise as soon as they were last month. In other words, there's a bit of a dovish pricing going into the FOMC. Based on 1 month back. So if you look 1 month from today to last month this time, you will see roughly a difference between, call it 25 basis points in the DEC 15 contracts, okay? I use the DEC 15 simply because that's more or less where the market's first rate hike is going to come, somewhere around the end of next year, okay? So I can determine, I can see how the interest rates are pricing just using that contract. Okay, some people may use a September 15, some people may use a June 15. Okay, but effectively, the market has shifted in that part of the curve by 25 basis points. Now, who thinks that that's big? Does anyone think it's big? Okay, I'll tell you guys, it's huge. It's absolutely huge, guys. In other words, the Fed dots, okay, effectively, for the end of 2015, we're looking somewhere around 1.25%. Okay, so if you go to that same time last year, or you effectively this time last month we were trading over here, we're now 25 more basis points further away from that 1.25. Okay, does it all make sense? How big a shift we've actually had over the course of the last 4 weeks. Okay, everyone happy with this? Straightforward, telling us that there is dovishness being priced in. Yes, of course, we got those explosive moves last week. Okay, but the important thing is to understand that the Sturs markets are not reflecting any kind of hike soon, any kind of hawkishness soon. Okay, so what we need to note is if Yellen comes out tomorrow, wonderful and upbeat, saying that, you know what, actually, we're starting to use this underutilization of labour. Bang! Hawkish. Well, I know the market is very dovish. Says something nice and hawkish, the market could move quite easily, quite fast in the hawkish direction if I'm trading the Sturs products. Okay, equally, let's say she comes out and maintains that we've got underutilization, maintains that inflation is below their target, maintains the considerable time. Okay, can this market rally? Can it rally a lot more than what it's already done over the last 4 or 5 weeks? Okay, do you all understand that? Everyone got that? Good. Next market, Max. Let's go to the bonds. Let's go to the back end of the curve. Why do we want to look at the back end? Why do we look at the 5s and 10s?
Because it's the one we trade.
Okay, it's the one we trade. More importantly, what does the Sturs show us that what does the 5s, 10s show us that the Sturs doesn't really show us? Okay, remember this is all about what? Interest rates, the Sturs. Okay, what are the 5, 10s about?
Inflation.
Inflation and growth, expectations. Okay, so in other words, the 5-year market will tell me 5 years from now where is inflation expected to be and where is growth expected to be. Okay, so let's have a brief look. What have we done over the course of the month? Okay, we rallied all the way from 2.68%. Okay, oh, I'm going to do that the other way. Draw the yields. Okay, yields collapsed from 2.67% all the way down to 1.85%. Okay, that was last 2 weeks ago. We've now bounced all the way back to 222, somewhere around there. Okay, so effectively, what have we done over the last 4 weeks? Well, we're still a good 45 basis points lower in terms of yield. Okay, and that's being reflected in that chart I showed you about the market's expectations about inflation. In other words, the market is saying they don't expect much inflation in the next 10 years. Okay, so again, if Yellen comes out and changes his stance on inflation, says, you know what, actually, inflation is now starting to tick towards where we think it should, okay, bang, she's suddenly hawkish in a market that's pricing very dovish inflation expectations. Everyone got that? You understand why it's so important to look at these markets individually? Okay, use the language, use the different ideas and understand how they will affect the market based on what it's been doing. Okay, good. Next market. Okay, go on. What are we going to do next? Okay, by the way, very important, you'll note, I always do the chart in terms of easiest to trade. Okay, whenever there's an interest rate decision, the easiest market is the interest rate products, which is bonds. Okay, what's the next easiest thing to trade for interest rates?
FX.
Okay, the dollar. Okay, so let's quickly look at the dollar. What did the dollar do over the course of the last 2-3 months?
Strength.
Okay, so we had that big strong rally. We spoke about the 8% rally. Okay, we said the dollar needed a pullback. What do you think it's done over the last 3-4 weeks? Okay, it's had a little 1.5% pullback. Okay, and that's the chart. I'll get it up for you now in a minute, but that's what I want to show you. Effectively now, the market's in a sideways mode. The dollar's not going anywhere. It's awaiting fresh information. So again, bang, Yellen comes out, says tapering down, we're going to start hiking rates soon. Okay, trend should continue. Dollar buying should continue. Okay, equally, if Yellen comes out and says, no, actually, you know what, this dollar's a bit too strong, well, we know the market is very long, so equally the market can continue this little bit of a consolidation move, this little bit of a pullback. Okay, all got that, yes?
It's quite probable, no?
Sorry?
It's likely that she will say that the dollar is too strong.
Possibly. Okay, remember, the whole idea is we have our scenarios, we have a hawkish, neutral, dovish scenarios, we look at the markets, we trade, and then we trade according to what comes out. We don't try and guess what Yellen, we're not hedge funds. We don't guess what Yellen's going to say, we trade based on what she tells us. Okay, the important thing is to understand which market's going to give you the most bang for your buck. You do the hard work, you've got to know which market's going to pay you. Okay, good. Equities, last one. Let's use the US equities. So what have the US equities done over the last month? Okay, we've gone from 1970s to 18s, all the way back to 1970s. So where are we over the course of the month?
Slightly
Okay.
positive. Like today.
Pretty much flat. Okay, yes, we had a whole bunch of volatility and there was some crazy stuff going on and global growth concerns, but effectively the equities have gone nowhere over the course of the month. Okay, yes, Max mentioned Bullard's comments. Since Bullard's comments, we have had a nice, very strong move up in the equities. Okay, so again, if that comment comes in, if Yellen throws in a, we could we could maybe do further QE, okay, how are the markets going to respond to that? Okay, more importantly, if you believe that the markets have rallied on Bullard's comments about more QE, then how should the market react when Yellen comes out hawkish or dovish or neutral? Okay, so you take the markets, all three of them or four of them, you go and determine how they're priced going into it. Okay, all of them currently, equities are up, dollars coming off, and the bonds are bid, which suggests to us what? It suggests the market is relatively dovish going into the FOMC. Okay, you all got that? Good. Then, once you've got your markets, once you've had a look, okay, by the way guys, just very important, please, I'm drawing you a macro look of a market, okay, I'm showing you what the dollar index has done. The important thing is to go and look at the nitty-gritties of your market, okay. For me, if I've got, and I'll use the example of the Euro FX, okay, so the Euro dollar against the GBP dollar. Okay, the Euro dollar effectively has sold off from 139. It's now come back, come up, come back down again, and it's kind of just doing these drip drab candles. Okay, whereas the pound has effectively done something like this. Okay, now of these two markets, which would I prefer to trade and why?
JPB,
Why?
because it's more clear the pattern.
Okay.
What is doing.
Good. So one, you can see there's a clear inverse head and shoulders type pattern. Okay. B, there's a very lack of interest going on in that market. Okay. Maybe for fundamental reasons, people are happy to keep selling the euro because of QE for all sorts of reasons. Okay. So in a hawkish scenario, in a dovish scenario, I'd far rather be buying that market, and in a dovish scenario, I'd far rather be selling that market. Okay, it's so important if you're a dollar trader to know which one am I going to trade where and why. Okay. Equally, if you look at the bonds, very quickly, okay, the bonds at the moment are doing what? Rallied, pulled back, but how are they pulling back? What does that suggest to you? What is that telling you when a market is going absolutely nowhere for 9 days in a row?
Yeah, I feel like every day we are doing the same day. The last 7 days,
Okay, good.
we just balanced. We did
Looking for a breakout.
95%.
Okay, so the market needs a kick. It needs a bit of volatility, whether that way or that way is
Did
irrelevant.
huge volume
Good,
in 86.
good, good,
Like
good.
95% of the volume.
So no,
in
good. So what
86.
Max is telling you effectively is we've got a lot of locked up energy now, sitting inside an 80 tick range. Okay, so it's not going to take a lot for suddenly the market to go that way or go that way. Okay, but if you don't do the analysis, if you don't know where these pinch points are, the market will be 150 ticks away from you, and you'll be like, oh, this trend came out of nowhere. Okay, understand these pinch points, guys. Make sure you choose the right market based on the right idea to trade. Okay, hang with me, Mark. I know we're almost there. We're almost there. Okay, so once we've got our market analysis, what do we do then? What's the next step? Okay, trade setups. I'm going to show you 3 basic trade setups for tomorrow. Okay, the first one is a continuation setup. Okay, so bang, Yellen comes out, says, listen, yeah, we could probably do more QE if need be. Okay, bang, in my head I know I'm dovish. Okay, bang, I know I'm trading the pound dollar because I want to trade the pound on a dovish comment to the upside. Okay, I know the pound has done an inverse head and shoulders. Okay, so what I'm looking for is I'm not looking to buy the high tick blip. Okay, because I can't manage my risk if I buy a high tick blip. Okay, but I know if she says something dovish, I should get a continuation pattern. How a continuation pattern works. It blips up, the market moves away very fast, it then pulls back. Okay, the very first pullback in a continuation type pattern is the one to be involved in. Okay, very simply, once it has found a low and once it has gone back bid, you buy the market with a stop below that first pullback point. Okay, your target is firstly the previous high, but the extension, it needs to extend. Okay, so if you're an afraid trader, what you do is you buy it there, you cover a little bit there, cover at the high retest. Don't be a euro and try and go, it has to go. It doesn't have to go. You cover some. Once it breaks through, you buy it back. Yes, you're going to pay a little bit, okay, but at least then you've got confirmation. You're paying for that confirmation. Okay, that is a continuation type trade setup. Okay, continuation trade setups tell me that there is new information in the market. Okay, in other words, the market didn't expect the Yellen to tell us that she could do more QE. Everyone got that? Good. The second setup, okay, is effectively a reversal pattern. Okay, and these are very typical. Why do you think you get reversal patterns so often? Bang, minutes come out. Sorry, yeah.
Oh, just yeah, because on the statements, on the release, the algos get crazy.
Good. Okay, brilliant. So, bang, statement comes out. Everything's the same, but Yellen's dropped considerable time. Okay, market blips down. Okay, I'm going to use the bonds as an example. Okay, so considerable time goes, markets blip down, and suddenly it starts to leak up a little bit like that. But you can see it's struggling, and it's struggling, and it's struggling, and it's struggling, and it's struggling. Okay, that is what you call a reversal pattern. In other words, the market blips down because the considerable time by the fast money has been deemed hawkish. But we all know, we're smart, we know considerable time doesn't mean necessarily hawkish. It's more a neutral comment because there's no time frame. And what we do is we wait for the break point of the first pullback, and somewhere over there. In other words, the market goes down, it'll pull back. Okay, it'll have a second go. Why does it have that second go? Because locals don't do homework. Locals don't understand that considerable time being dropped is not necessarily hawkish. Okay, so what they do is they sell it there. The minute that market gets back above that point, that's when you want to be buying for the reversal trade. Okay, again, when it gets back above that point, your stop is sitting below there. Good risk-reward opportunity. Your target is the highs. Okay, again, be very careful. Don't be buying into highs. Don't buy on the way up. Buy on the little pullbacks. Buy into the stupid locals that decide that it's hawkish, has to go down. Everyone got that? That's a reversal trade setup when we have FOMC, ECB, all these things. Okay, and the last one is what you call a undecided market. Okay, remember with reversals, guys, please, the difference between a reversal and undecided is reversal blips down, comes back, has a look, and then goes. It's speedy. It moves to the high. It doesn't slowly go there. It captures positions and then reverses those positions. Okay, that's a reversal. The one that I'm going to show you now, where it's undecided, okay, is where you get a P-type or a B-type distribution. Okay, how does it work? Let's use the same thing. Market blips down, comes back, has a second look, comes back, has a second look. Okay, so effectively, the market struggles to go in any direction.
It's probably the one we're going to get.
Okay, probably, who knows. Okay, but the important thing is, how are you going to trade this, okay, compared to a continuation, compared to a reversal? Okay, you need to know the three setups. They're all very typical in FOMCs, ECBs, all that kind of thing. Okay, they've all got very unique characteristics. And they've all got very unique entry points. Okay, it's your homework to determine the entry points. Okay, everyone got that? What's the last step? The last thing in our wonderful concocted plan for FOMC. The last most important thing. Okay, I've showed you your trade setups. Now what?
Execution.
Okay, your execution. Okay, and in your execution comes your risk management and your money management. Okay, and what's easy about this is you say, well, if I'm expecting a continuation pattern, because Yellen said they can taper more, what I'm looking to do is effectively, in the pound, what I'm expecting to do is on that first pullback, okay, I'm buying a 20 lot, I'm buying at market with a 10 tick stop, because I know a 10 tick stop is going to cost me £1,000, okay, and I'm looking for 25 plus ticks or 30 or whatever it may be. Okay, my risk reward makes sense, my stop makes sense, I know it's a bit more volatile. What kind of clip am I using? Smaller clip because of the volatility. Okay, most traders stop short here. They just click anything. Okay, and the problem is when you just click, you're not used to volatile conditions. You're not used to markets going 30, 40 ticks in 2-3 minutes. Okay, so if you don't plan this part, yes, you're going to make money. Of course you can. Anyone can just buy it. Okay, but you're going to sell yourself short. When you should be making £1,000, you're going to make £300. Okay, when you could have made your month in one trade, you're going to have to spend the next couple of days making your month. Okay, please guys, don't stop short just at, oh, this is the trade that you're hawkish dovish. Make sure you plan exactly how you're going to execute. And I know it's never this straightforward. Okay, but have an idea in your mind. If your normal clip is 2 and something very hawkish comes out, well, bang, I'm using 4. Okay, and I know if it's very hawkish, like she says, you know what, They're pretty much going to hike rates in the next 6 months. Okay, I know that I've got a high probability of making money, so I'm going to give myself a decent stop. I'll risk maybe 2/3 of my entire day on this one trade. Okay, if you make that decision before the event, when the event comes, you won't think, you won't worry. Bang, you've heard it. Bang, you thought fallout. Bang, you thought 10 tick stop. Straightforward. You will make money, guaranteed in that situation. You get stopped out, so what? You go and you say, I executed my plan. I couldn't have done anything better in my control. To understand that, make sure you go through your risk management and your money management on your strategies. Okay, that's the FOMC, guys. It's straightforward. Okay, you have your scenarios, bang, it comes out. You read the scenarios, you look at the chart, you execute the chart based on what your plan is. As simple as that. If it doesn't come out according to your plan, what do? Sit there. Just watch it. Not your game, not your fight. Okay, we're here to make money. We're not here to get it right. We're here to make money. How do you make money? That's what you got to do in this FOMC tomorrow night.
Yes, sir.
Okay. Please, guys, make sure you've done your plan when you come in tomorrow morning, not when Imran sits here with you. Have your plan written out. Even if it's shorter than mine, it doesn't have to be long, but have a plan. Have an idea as to which market you're going to trade, how you're going to trade, what pattern you're looking for, what you're looking for from the FOMC. Okay, if you only want a year no tape and that's the only thing you want to trade, that's fine. Okay, make a concise plan on just that one thing. Okay, are there any questions? Does anyone want to add anything? Max, you want to add anything? Okay, have a good evening, guys.
Cheers.